everyone, I'm Sabrina.
And I'm Jonathan, and we are the lawyers at Verity Law.
It's time to file your taxes. What are some important things to watch out for?
First, your accountant needs to tell CRA whether your house is a principal residence or an investment property. This is important because when you sell your principal residence one day, it's tax-free. You get the entire sale proceeds without needing to pay taxes on this income.
In contrast, if your accountant tells CRA that your house is an investment property, then you must pay capital gains when you sell the house. This tax is usually very high, and for how much it actually is, please consult a professional accountant.
Now, many clients ask us, but if I only have one house, that should automatically be considered my principal residence, right?
Well, that depends on whether you, your spouse, or your children live in the house. What if you only have one house in Canada, but all of your family live in United States? Then there's no way that single house in Canada is your principal residence.
Very true. Now, to claim principal residence tax exemption, you must live in the house and have your accountant designate that house as your principal residence when doing your tax returns each year.
This is especially important for new homes that you buy from the builder. There is a significant tax refund if you decide to live in the new home as your principal residence. To claim this refund, you should inform the builder that you're buying the new house as your principal residence, or hire an accountant immediately after your real estate purchase to receive the refund.
And it doesn't matter if you're also renting out the property. A principal residence can be a house in which you live, but also rent out a section of it, like the basement. The main requirement is that you or your immediate family members live inside the property.
Exactly. Specifying which house is your principal residence is also important for matrimonial home dispute. As our viewers know, a matrimonial home is one where you and your spouse live in on a routine basis. This means that even if only one spouse is on title, the other one is not, when you get a divorce or pass away, the spouse not on title will still have a claim to the house.
Exactly. And your principal residence would be your matrimonial home if the spouse lives there with you. Thus, if your accountant has been telling CRA that property A is your principal residence, it really makes no sense for your spouse to claim property B is the matrimonial home. For the most part, your principal residence is your matrimonial home.
That's right. So next, let's talk about estate taxes. As our viewers know, when we pass, most of our assets will be immediately frozen. We must apply to the court for an approval document. Once received, the assets will be unfrozen and given to our beneficiaries.
Exactly. And after this approval document is received, the estate trustee, which is the person who manages the estate, must pay something called an estate administration tax. This is roughly 1.5% of the estate value, though the first $50,000 will be tax-free. So for an example, an estate worth $1 million would have estate taxes of approximately $14,250.
That's right. And when do you pay this? The estate tax is due either at the time that you submit the application for court approval, or if your lawyer is skilled, it is due 180 days after you receive the court approval document to unfreeze the estate assets. Also, the estate trustee must file for the deceased's last year of income tax return, called terminal tax return.
If the deceased and their beneficiaries are spouses of each other, then this terminal tax return is actually pretty easy. Most assets can actually be transferred between spouses tax-free. For details, consult your accountant.
But if the deceased and the beneficiaries are parent and children, then it becomes more problematic. Even if the deceased gifted their estate to their children, CRA considers that they sold it to their children in the year of their deaths. The taxes on the sale proceeds must be paid first, and then the inheritance can be given to the children. Depending on how much value is in the estate, this could mean a large sum of taxes.
Luckily, once the beneficiaries receive their inheritance, they do not need to pay taxes again. This is a huge benefit in Canada because in some other countries, inheritances are also taxed.
Now, you may ask, is it better for taxes if we just add our children onto the house now as joint tenants? That way, once we pass, our children can inherit the house automatically through a real estate lawyer without needing to pay the 1.5% estate administration taxes.
Correct. You can avoid estate taxes this way. However, this may result in income taxes for your beneficiaries. For example, if your son already owns House A and you add him onto the title of that house, House B would then become his investment property.
This means that once House B is sold, your son must pay capital gains on his portion of the house. In contrast, if you give House B to your son through a will, then that house becomes your estate property.
As long as the estate property was used as a principal residence, your son can sell the property under your name in the year that you pass, tax-free, and the sale proceeds that your son receives would also be tax-free.
Ah, that is a very smart way to avoid capital gains.
For sure. In most cases, if it's between paying the 1.5% estate taxes on your principal residence or capital gains on an investment property, the estate taxes are much cheaper.
Next, let's shift over to our business clients. Many people incorporate a company to reduce their income taxes.
Yes, for the most part, corporate taxes are much lower than individual taxes collected on your payroll. Thus, when business owners start making good money, they often choose to incorporate. They will leave their extra earnings in the corporation to be taxed at a lower amount, rather than distributing those earnings to all of the shareholders or putting them on their T4 payroll, which has a higher tax rate.
That's right. Incorporating a company is also a great way to limit liability. When you operate a business under your personal name, it means all your earnings go into your own bank account. At the same time, you also have unlimited liability. If someone succeeds in suing you, all of your personal assets, including your own house, car, and bank accounts, can be taken away.
In contrast, when you do business using a corporation, only the assets in the corporation are at risk, such as the office owned by the corporation or the corporation's bank accounts. With a few exceptions, anything that is not under the ownership of the corporation is protected. So if your customer succeeds in suing your company, they cannot go after your personal assets, such as your home or your car.
This is why even if your customers win a litigation against your corporation, if the corporation has no more money left in its business bank account, they don't get any money anyways. They cannot go after the owner's personal assets unless it falls into a few exceptions, which we'll go over in our future videos.
You can actually be even safer than that. Even though only the money in your corporation can be used, you don't want to bankrupt the corporation anytime there's a conflict. Now, operating corporations, which are companies that do active business with customers, are most likely to be engaged in conflicts and be sued.
Of course. For example, operating companies can be sued by clients who are unhappy with the services they received, employees for unpaid wages and overtime, suppliers for unpaid invoices, landlord for missed rent payments, etc.
In contrast, holding companies are corporations that do not engage in active business. They're used to hold assets like real estate and make investments. They're often the shareholders or owners of operating companies.
Because holding companies do not engage in active business, they won't have clients, employees, suppliers, landlords who can sue them. There is very little chance they will engage in conflict with anyone or be legitimately sued. Then a good solution is to move all extra money from the operating company to the holding company.
This way, even if the operating company gets sued and loses all of its assets, the assets already in the holding company are protected.
But many people ask, isn't it the same thing if I just move the assets from the operating company to my own personal bank account?
Well, yes, that would also protect it as long as you don't get personally sued as well. But in that case, there would be big tax consequences if all of your earnings become your taxable personal income.
Very true. In contrast, if my extra earnings are placed in my holding company, then the taxes will be lower. Corporate taxes are usually lower than personal taxes.
Lastly, let's touch briefly on trusts. Like corporations, trusts can be a way to limit your liability. The assets within the trust are protected against many types of lawsuits and bankruptcy.
To ensure maximum safety, the person who set up the trust, the settlor, and the person who manages the trust, the trustee, should be different from the people who receive the funds, the beneficiaries. That way, even if the settlers and the trustees get sued, the money already in the trust, which belong only to the beneficiaries, are safe.
However, trusts may not always be a good way to reduce your taxes. This is because the money that is in a trust is taxed at a very high rate. To reduce taxes, trustees often distribute all earnings within the trust to the beneficiaries at tax year end. That way, very little profit is left in the trust to be taxed.
Also, Since the beneficiaries for the trust are often younger with no active income, the money they receive from the trust is their sole source of income. This will also reduce their taxable income amount for the year.
Exactly. In summary, when filing your taxes this year, remind your accountant to declare which property is your principal residence. If you are married and have multiple principal residences, you really should come to us and register a declaration clearly stating which one house is the matrimonial home that would be split upon your divorce.
Correct. And when deciding between adding your children onto the deed now or leaving the house to them in a will, remember the 1.5 estate taxes on your principal residence is usually much lower than the capital gains on their investment property. Meaning for tax considerations, you should leave your principal residence to your children using a will.
And lastly, incorporating an operating company, holding company, and setting up a trust are all great ways to reduce both your liability and to prepare for efficient tax planning.
All right, that is all for today. Wishing everyone a happy tax season. We will see you all in our next month's video.